Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, January 19th, 2023. I want to do an update on the equity markets, mainly focus on that, maybe a couple trade ideas, and time permitting, I'll expand on some of the other things. But let's just look at the stock market now because I think that's really we're at kind of a make it or break it near term level, not so much long term, but just that's where my focus has been lying lately. Where we're going over the next few days more so than the next couple months right now. That's still obviously the other one's always up in the air, but at this point in time, like I said, I can make a decent case either way. So let's start out here. So there's that near-term pullback target, 274.81, give or take. That's been hit, and that's that previous reaction high there. And QQQ, you also have a little bit lower level right here. So that it's really a support zone that's right on it right now, as we were this morning in pre-market. Now, here's why I want to do the video. It helps me just kind of convey my thoughts. This is I think right now where we're at, we can go either way. I still favor the bounce. I threw that out there to you. We haven't hit my bounce targets yet. We did get one this morning. It was certainly a tradable bounce if you were trading the Qs. Here, we'll go to that in pre-market. Let's say, for example, turn on the pre-market trades, edit chart properties, always show last two. Well, it's going to show the last two sessions. That mucks it up. In the morning, it'll show me just this morning's. But let me just turn that off and we'll do the futures when that's selected there. But before I move on, here's a 15-minute chart. There's a divergence. There's a alternate trend line that was broken. There we go. We're oversold on that 15-minute time frame, but I think the futures are going to tell us a bit better story. So let me jump over there. This is the got a chart out to you this morning. Let me expand that up there a little bit. Go back to that, grab the top of that chart, move it up there. So we're looking at NQ, and so here's a couple things that happen. We had a breakout. It was a nice clean little wedge there, and that was also at the lows today. QQQ was at that support level, and I didn't post it, but SPY was at support, small caps, and we broke out, and they're selling into that breakout pretty hard. We had positive divergence, everything you wanted to see, and we got pretty close, but not all the way up to my first target. I listed 3 targets for you. So the reason I want to do the video and convey my thoughts, it's like one of those games. Here we are, we're in playoffs right now. Are heading in the playoffs with the NFL, and it's like it's a good game. We had the wild card games this weekend. I'm from Miami originally, so I'll use the Dolphins and the Bills. Buffalo was highly favored to win, but Miami gave them a good run for their money. And bottom line, it was anybody's game up until last minute, and that's what it's like right here. So while I still especially more so this morning, a little less right now, but I favored that bounce, a tradable bounce off the support levels we're at. I still favor it. Again, a little less. Why? Because this is, we say the charts are very dynamic, minute by minute, second by second. That breakout, the Bulls should have took the ball and run right there, and they didn't. What happens is that rally was met with pretty impulsive selling. I'll turn on the volume. You can probably see it here. Some pretty hard selling this morning, and they faded that breakout. And again, this is just a little pattern. Let's go back to a little bit more significant. More folks watch these daily and weekly, or I'm sorry, the daily and 60-minute charts. That's not showing you what I wanted to there. Okay, so I had the support level there on QQQ. And I told you to keep the bullish case intact. We could go all the way down to really all the way down here and still rally, and that's just a breakout or a back test of the recent trading range there. Not ideal. Ideal is if this market, because I always view things in terms of buyers and sellers, supply demand dynamics. And to end a downtrend and begin an uptrend, and again, that uptrend, I'm not defining the time frame, whether it's an uptrend lasting just days, lasting weeks, months. That's all relative to the time frame you're talking about. But in order to get that and show that there has been a shift in supply-demand dynamics, the buyers should be stepping in here. There shouldn't be that many more sellers. I think a lot of this was short covering, and it also kind of swayed sentiment. Everything I've talked about, that finally people realizing the inflation has been abating. But what we're also doing right now, there's some cross currents out there fundamentally from a macro or economic perspective. So on one hand, yes, we've had the abatement that I've talked about in inflationary forces. We're not down to where we need to be, where the Fed's going to stop cutting completely or even lower rates, but we've certainly seen an abatement. Now, on the other side, there's signs that the consumer's starting to tuck in, and so that obviously plays in, and that is, let's just say, as big or bigger. More importantly, now there are only a few data points, but a few data points and a few more and a few more, and then it starts to make a trend. And as I said, consumer spending accounts for 2/3 of GDP. So government can stimulate all they want, spend all they want. If the consumer stops spending, the economy slows down or goes into a recession. All right, so let me just keep it very simple and talk technicals. The fact that we hit that level and tried to mount a bounce this morning and that bounce got sold into, you can see it right there, so far is not good. And so therefore, yes, I am less optimistic of a bounce today back to that, those targets I gave you earlier than I was this morning because of that. We're clinging by the skin of our teeth to that support level on QQQ, or we're really just a hair below it. But you know me, I'm the king of watching multiple, not just multiple time frames on a security that I'm trading, but also when it comes to the stock market, watching multiple indices, particularly both the SPY and QQQ. You can watch a Dow if you want, but the Dow is only 30 stocks. And then I'm going to speak a little bit about that, and then we'll probably just keep the video contained to the stock market here. But there it is. This is that trading range. You can see it boxed in right here at that. Let me grab a box tool on my drawing tool here. Box, that is a frame tool. And there it is. That was the trading range, very, very well defined, what I call the Christmas trading range. It was really mid-December all the way through almost mid to late early January right there, and boom, 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 ping pong, and then breakout, and then a successful back test, right? That even helps to validate that level further as 387.17 as a significant former resistance, then support. Resistance once broken becomes support. And here we are, we're back down to it right now. So that is a very, very good support level on SPY on the 60-minute chart. And so therefore, that's why I'm giving my Qs a little more room and still favoring the bounce scenario, especially considering how oversold we are in the very near term. And we're even oversold. Yeah, we're oversold here on the 60-minute chart. So therefore, that's it. I think what they're doing right now, I think a lot of traders are probably like me. I like to believe that, if you're going to trade, I always said this, if you're going to sit and trade the indexes, why do you want to trade the S&P 500, which is so diluted and diversified with the most bullish and bearish sectors? You have defensive issues, and then you have high growth tech, and whereas QQQ is it's still, you have that diversification, 100 securities, so you're not going to get clocked on a gap down, in any one stock, even if it's Apple. There's 99 other companies in there that are going to help offset it. And so to me, you're either going to be right or wrong in the stock market. The QQQ, NASDAQ 100 and SPY, not necessarily minute by minute, day to day, but overall the trends mirror each other. The NASDAQ 100 in a growth environment or a bull market goes up more, and typically in a bear market it drops more. The one exception was 2008 financial crisis, because the NASDAQ didn't have any financial stocks. It doesn't have any banks, or very little to virtually no weighting in the financial sector, whereas the S&P, especially back then, that was one of, if not the largest sector back then. And that's why they both dropped about 55, 56%. No, wait, I'm kind of digress. I just want to point that out. But just about every other point in time, you're going to get more bang for your buck. And it's kind of like trading gold. I talked about this before. I'll analyze gold, but I'll usually trade, my proxies for it are GDX, the mining stocks, because if you get the call on gold right, GDX is going to go up or down if you're bearish and shorting gold. It's going to go up or down a multiplier of gold, and it's not a set multiplier, but let's say 1.5% at least usually. And so again, you're either going to be right or wrong on gold, and you can trade gold and maybe get 10% on a trend, or you can trade the miners and get maybe 20% on that trend. And then same thing with silver. So anywho, however, with that being said, the S&P, even though it's not my preferred trading proxy, there are times I will, and I'm going to talk on that here in just a second, but there are a lot of traders and institutions that trade that. That is still the big index. It's, I don't know, I've never seen a 401k plan. I used to, manage money professionally as a stockbroker, financial advisor. I've never seen a 401k plan with the NASDAQ 100 fund in there. Maybe it exists, but they tend to have an S&P 500 index fund, a Russell 2000 small cap, a mid cap fund, etc. And so, point being that there is a lot of traders. So, although QQQ is below support, those traders might be getting stopped out right now because it took out that level I gave you. But guess what? At the same time, SPY's at support. So, quite likely, I still favor the buyers to step in here. Now, if they don't, then something's wrong. It goes back to my analogy of these, watching a good football game or whatever your sport is, where it's anybody's game. You might have your own bias as to whether of course, that your team's going to win, but a close game is just that. It can go either way. And quite often, in sports, and the same thing in the stock market, quite often the team who's favored, there's upsets. And so we'll be watching for that. That's where I'm going with this. If we get an upset, and all of a sudden this support level, which should by just about all accounts, especially in the bullish scenario, should hold and get a reaction. If we break down there, then something different is going on. It tells me that there is quite a bit of a selling out there, and it could be whatever. It doesn't matter the cause of supply and demand dynamics. One thing out there is what's their name? I'm blanking now, but the parent company that runs those Bitcoin and Trust and Ethereum, GBTC. This was kind of, the writing was on the wall, but it's official today. They've declared Chapter 11 bankruptcy. Now these guys, it doesn't mean these guys are going to go away. So if you follow the financial markets, companies declare bankruptcy all the time. Airlines, I think every one of them's gone through Chapter 11 bankruptcy. The name stays the same. The planes stay the same. Not always. Sometimes companies are liquidated, but it just restructures the capital structure, the owner of the company. Typically the stockholders are wiped out, get little if anything. Bondholders get paid whatever there is, and so there's a reorganization. Now, with that being said, we've had problems in the crypto arena. I pretty emphatically stated this was a good time to close all, take any profits if you were still in, caught that GBTC, the Bitcoin trade, especially during these guys. So I'm just kind of digressing here, but saying this could be a shoe to drop. Like I said, I've been saying for a long time that Wall Street just couldn't resist. It's what they do. I'm not trying to be cynical, but they had to get their greedy hands in the cookie jar. And again, that's what they do. These financial institutions, their job is to make money, and they although most of them didn't believe in Bitcoin, but they couldn't resist when it was going up, and there was a lot of demand from the public. It's pull demand. There's two types, pull and push demand. And so the public wanted these things. And so anyway, Wall Street really got their hands way down in the cookie jar. And this whole crypto thing, the unwinding of it may or may not be over, and probably isn't. And then, so what happens, I didn't look into the structure of these. Bitcoin Trust is not an ETF. I've said that many times before in the past in these videos. It's an ETF-like instrument. ETNs are not ETFs. The difference of an ETF, an exchange-traded fund, it invests in whatever it's tracking. And ETNs, and this is something a little in between, ETNs are only an IOU, and I've seen ETNs blow up. In fact, I had some. It was a VXX or whatever it was. One of those VIX tracking ETNs a few years back blew up when the VIX went up too fast, and the fund wasn't structured to accommodate such a fast move, and the thing went poof. It went bye-bye. And that is a possibility. I can't tell you for sure. I haven't read through the prospectus here, but I can tell you this is not an ETF. This is run by a company that's declared Chapter 11 bankruptcy, as with ETHE. And all I'm trying to say is be careful. You know, on one hand, the allure to these at times, because they do, I'm not sure if you're aware, but they trade at a discount or premium to the price of Bitcoin and Ethereum. And so there's been a lot of arb trading in these arbitrage, where if it's selling at a 10% discount to the price of Bitcoin on GBTC, then there may be an arb trade there where you buy this and it closes that gap and goes back to parity or even a premium. I'm probably getting a little too ahead of myself here, but you need to know these things, and so I think that's one thing that's buoyed it up. The Reddit most recently was trading at about a 20% discount to the price of Bitcoin. But again, you do what you want, but the risk reward to me, and that's what every trade is about, is not favorable. The risk of waking up to find out that something happened within the structure of this, and they can mark it down 50% in a day, they can mark it down 80, it can halt trading. That's it. So be warned. And then where I'm going with all this too is back to the point. I know sometimes I go off on these seeming tangents, but there's kind of a reason behind that. Is that hey, something could blow up. Like I said, a lot of big institutions, pension funds, hedge funds, all the types of investment accounts, investment managers have, some resisted, some got on earlier than later, but a lot joined the party late, and you could see things blow up. Crypto is still, the risk. Crypto may not have bottomed. There may be a lot more downside. It's just too risky right now. Anyway, so that's it. Like I said, we caught a nice pop in the cryptos, and at least me, and I'm out. So you guys do what you want, but just be forewarned about GBTC and ETHE and ETCG. All right, that's it. So let's not overanalyze it. The SPY is at support. I told you the buyers should step in here. I told you I think the buyers will step in here, and I told you if they don't step in here, something's wrong. So you may consider stops below, and including on QQQ. Let me show you the small caps real quick. This is a 60-minute chart. I haven't updated my 60 in a while on IWM. Let's see what it looks like on the daily. Oh, so here's an example of IWM, where the buyers should step in. There's our primary bear market downtrend line. We recently broke out, and now we're making a perfect back test as I do this video. So the buyers should step in there and turn around and rally, and I think they will, but there are no guarantees to that. And if they don't, then that's pretty darn bearish, not to see a buyer step in and buy a perfect back test after a breakout of something like that. And then when I look at the futures, let me show you that real quick. RTY, I'm looking down below. I've got here it is. These are levels I've had on this chart for a while. I haven't posted it in the last couple days, but there's an uptrend line. We're probably going to hit, could hit, most likely will hit. We're also at a decent price support now. So again, I'm favoring a bounce here. How far it goes, that wasn't the goal here. I'll have to sharpen my pencil, but that is the next level that I have on the chart, resistance level. So there's a likely bounce target. And if we go down and take that out, then this is the next decent support level, the uptrend line right there. And then last but not least, I showed you SPY, which is the S&P 500. At very good support, and this is ES, the S&P 500 futures, and also a good support. The trading range is not as well defined, but you can see, I had it boxed the top of it more of a zone, and I showed it to you as a ascending triangle pattern. In other words, you have a flat resistance level, a horizontal resistance level up top, and an upward sloping trend line. And that we broke out above it, back tested it just like SPY, of course, and then moved up, and then recently put in the divergent high. So this is where I started saying, I'm out, I'm selling, I'm shorting. Everyone else wants to buy the breakout, but I bought it pre-breakout brought it down here. So therefore, that's, I'm trying to always be a step ahead of the masses. If you're trading with the masses and with the herd loses money. The majority of traders in the market lose money. So you've got to be a step ahead. Doesn't always work, but that's what I try to do. Anyways, big nice support here. 39.02. Why is it good support? We have reactions all the way back here. Quite a few in here. That's the bottom of this former resistance, now support zone. That's where we back tested last time. If they take it down, it's not the end of the world. It would be a caution sign. And let me tell you another way I look at that. If we break that down, there's the uptrend line there that's likely to come into support. We break that, that's just pretty darn ugly. I can't, no way to spin that as positive. But let me show you something. So my thought process works like this. So this is, as it was this morning, same level, point out, an objective level to go long. Very objective, high probability, but go long with a stop somewhat below. If we go down below, I wouldn't add to any long positions. Again, depending on where, I wouldn't, even if I didn't have any positions, I would not add. But then again, I wouldn't necessarily stop out right away because we have support just below, and that would be a great stop clearing level. If the powers that be can take it down there, they're going to clear a lot of stops. They're going to suck in a lot of shorts, and then they're going to ramp it up, and those shorts are going to get blown out. So in other words, this is to me, pretty much a hard buy here. Covered my short this morning, it was NASDAQ 100 and reversed to a long, and I will hold that down to, but not much below this trend line right there. Anything other than a very brief spike, we need to see recovery. Now, if that happens, let me take it even one more step further. Okay, so I wouldn't continue to scale in. Pros typically average up on a position, not down. Retail traders, i.e. dumb money, no, I'm not trying to sound offensive, but that's just the terminology or the vernacular on Wall Street. The retail traders are considered the dumb money, the pros are considered the smart money. They're not always so smart, just using a term, please don't be offended. But the smart money will average up on a position because that tells them they bought something, and if it starts to play out, they were right on their analysis. And if it goes down, if they buy something here for that reason and it starts going down, then they were wrong. So they don't average down on a position. That's just something retail traders do because they think they're getting, lowering their cost basis. But again, for those reasons, I wouldn't add there. And then I would consider stopping out, whether it's a hard stop or a quick scale out. Sometimes I'll scale out of a position with staggered stops, stop 1, 2, 3. Sometimes it's a hard stop. And but as of now, this is what I favor. And targets on S&P, if you're trading it, since I'm already here, I'm going to give you one more line. Look at these gaps. You have a gap right here. Bottom of the gap would be really the where we opened today. I'm going to pull that line down. So these are your logical targets or stopping points or reaction points for a rally. And I think this one could carry easily all the way back up to here, especially if you look at what's going on the shorter term charts. You have some, not so much there. You have it on the futures, at least on NQ. You still have, there is a wedge, even though we had a little false pop and a back test or move back into the wedge. You do have pretty strong positive divergence on these short-term time frames right now. That's a 10-minute chart. That's what I showed you today. You'll see it on the 5 and the 15. So there's some positive divergence, and then again, minimum target, second target, at this point in time, max bounce target, meaning, we'll get up there, depending on what the charts look like, 5-minute, all that, I may try to game a pullback, or I may just raise my stops and let it run. And then again, I showed you where I would stop out if we keep going to the downside. So last but not least, and told you I'd just stick to the equity markets. Let's talk about some of the recent trade ideas I got out to you today. Caterpillar broke down. And again, this is just like the one I gave you yesterday, KHC. It wasn't like it gapped down. That was if you had a price alert, you shorted it in the morning, and you made a single day on a blue chip. So you could have doubled up, a pretty heavy position. You're not going to get clocked on, on KHC on the long side. That thing dropped almost 6% in a single day. So you're very close to first target. Nothing goes straight down. The buyers, as It's like Pavlov's dogs. The dip buyers have to just step in and buy that, unless something goes down only so much right away. That's probably your likely bounce back target right here. Right around there is resistance. If it gets, 40, 48, depending on what's going on with the stock market, that might be an objective add-on if you took it yesterday and you wanted to add a little more, and then cover on that 39 target, or trade it long for a bounce. Again, depending on what the market's doing. In other words, if we get down to 39, we're heading there, and all of a sudden the S&P breaks back down below that recent trading range I just covered, and then smashes below the lows. Guess what? KHC is only going to rally so much with the broad market going down, because this is a S&P 500 component. And then the other ones I gave you today, Caterpillar, same thing. Break of the trend line. Since I got that out to you, there it is. And it was not a gap down. It was a nice, easy, objective short entry. And we're about a quarter, almost halfway down to the first target. And then there's your second target. And then these are potential additional targets if and when. Now, the whole point of this, and there's one more. Let me give you that. No, let me just... Didn't I have one more I covered today? Hold on one sec. Oh yeah, it was Boeing. I got that one out to you. Boeing is right on the line. I ever so slightly tweaked this uptrend line. This is the same. This is how I got it out to you today. So we're on trend line support right now. It's a bearish rising wedge. There's negative divergence, and just based on my experience and the look of this chart, it's a breakdown is likely and imminent. We could get another bounce. We could run all the way up that 231.15-ish. I'm going to pull that down a hair. Resistance, but ultimately I think this one breaks down. And if it does, then you have Caterpillar already breaking down. That's KHC. You'll have Boeing, and it goes to my whole bear market is for the rest of us thing I was talking about yesterday, where the Dow and S&P being the the relative outperformers throughout this entire bear market because of these steady Eddie blue chip so-called quote-unquote recession-proof stocks, KHC, Kraft Heinz. Well, Caterpillar's not necessarily. Caterpillar's actually the opposite. That's an industrial stock. The economy goes into recession. Yeah, Caterpillar is going to feel the pain. You stop. They don't order as many bulldozers and cranes because construction slows down. But KHC typically should be a recession-proof stock. But at the bottom end of the day, these are Dow components, and you'll see, I think, a pretty good. Possibly even outperformance on the Dow and the S&P on the next leg down, because tech led the way down, and tech has already had a heck of a correction. You have stocks like, let's just pick, well, there's one that I've highlighted a lot recently. You have Amazon down, what is it, 50 something percent, 56, almost 57% off its highs. Other big names, Alphabet, Meta, we all know what happened to Meta, the semis all clocked. So tech has already, and as it should be, because when you shift from a high growth environment, strong growth economy, to slowing growth, the high growth stocks are the first to get hit. But then, like I said, it's a bear market as for the rest of us. They're going to come after the steady Eddie, quote unquote, safe haven stocks. But I've been through enough bear markets to know that just like all ships are lifted in a rising tide, meaning just about all stocks and sectors go up in a bull market, the inverse happens when the tide falls. And so what you want to look for, and like I said, the market will go out, the bear market sends its little snipers out, and they find those stocks that didn't get the memo, like Caterpillar, and at all-time trading at all-time highs, and the other ones I mentioned. So there it is. So that's the thing, and the takeaway too is that right now it's a better time to look at for the next leg down, whenever you think that time is, whether it's now or after a bounce, to maybe short the S&P 500. Still, you tend to have less volatility because of the diversification in there, but maybe the Qs are too volatile for you, or the small caps are too volatile for you. Yeah, I told you I'd limit it to broad markets. I'm only at 28 minutes, almost 29. I'm gonna just real quick get to the an update on gold and silver because where we're at, what happened today. So there it is. All along I've been kind of point out there's a little trading range and said, look, to me it looks like a tradable bounce, a nice trend reversal is coming very soon in the dollar. Trend line's not great. This is US DOLR, the dollar index, and I said, look, there's a trend line, but I acknowledge, hey, we could break that. And if we do, we come down here, and that's it. That's my max. We just tagged that. You can see the dollar index close enough. Put a little hammer in there, right there, candlestick, and close enough. Look at that divergence. So I still believe a nice bounce in the dollar is coming, which is a pullback in the euro, which means a pullback in gold and silver. I remain and have been emphatically bullish, longer term bullish on gold and silver ever since gold had that little false breakdown and recovered the key resistance level. But when I look at this, look at the divergence forming on the euro. Yeah, longer term, I'm bearish on the dollar, bullish on the euro, bullish on gold and silver. Remember, the euro and gold move in tandem because of the relationship. And the euro, of course, is just opposite the dollar because it's the biggest weighting in the dollar index. And it's a simple mathematical relationship. I know I say this often. Gold, at least the gold you and I are, or not all of us, some of you are across the pond, but the gold that I'm trading, GC gold futures and gold mining stocks, GDX and GLD, the ETF, or you go down to the jewelry store, you're trading it in US dollars. And at many parts around the world, it is trading the dollar. So when the dollar is weak and falling, it takes more dollars to buy 1 ounce of gold. And likewise, when the dollar is strong and rising, it takes fewer dollars. That's why you have that relationship. And the other, so that is an immutable relationship, but there is another variable, a very powerful one, supply and demand. So it is not a one-to-one guarantee offset every time the dollar goes up, gold goes down. But if you, and I've done this many times, I don't want to go too long in this video, pull a long-term chart, go back 10, 20, 40 years if you want, compare gold and the US dollar, and you will see that unmistakable relationship with a few periods of a disconnect. So therefore, if we get this, if these divergences, as I suspect they will, play out, we get a correction in the euro, we already had the one back test that I was looking for. It's possible that's it. I mean, this was a powerful breakout of a downtrend line, but with the negative divergences, I suspect we'll get one more pullback in the euro, and there's also that downtrend line. That's what I'm targeting. So there's my pullback target. And to that, I'll show you in a second here when we get a sell signal, especially on silver. I'll ride that down, pull back gold, silver, then I'll reload back in my long-term accounts for the next leg up in the euro and gold, silver, and the mining stocks as well, unless there's a meltdown in the market. That's the only time I underweight the miners or just exclude them and might hold gold if it's a flight to safety bid in gold and the market's in kind of semi-crash mode, because that can pull the miners down. Otherwise, the miners will go up and down with gold. So let me just show you without going through a million charts. This is the one I highlighted recently. We had a uptrend line in silver. I told you silver's not going to go anywhere until its big brother gold reverses. Gold's still in an uptrend without any good sell signals. Silver broke down recently. These are silver futures, 3-month chart, hourly candles, SI, and this is the level we've been bouncing. On my last update, I told you this is a level that needs to go to get a sell signal, and that level is 23,341, give or take. And we hit it again today. So here's what I'm seeing. Tap, tap, tap. I see a big trading range. I'm favoring a downside break for the reasons I just mentioned in the currencies, but anything's possible. We get an upside break, we can just burn through the divergences and continue the bull market in gold and silver. That's one thing about them. When there's every now and then, they're not as trendy as natural gas, which is usually in an uptrend or a downtrend, very little in between periods. Gold and silver, there's kind of a every few years there's kind of everything aligns, the setup in the currencies, and then that all of a sudden everybody wants to buy gold again. And I think a big part of it, remember, when Bitcoin came around, oh my God, if I didn't hear this once, I heard 1,000 times. Everybody said gold's dead as a store, a flight to safety. Bitcoin's the new alternative to the dollar, and the stock market and the new safe haven trade. But now that the Bitcoin trade is clearly blown up, gold's back in favor again as an alternative because that's a lot of people worried about us going into recession. So anyway, just keep it simple. I'm gonna pull that line down just a hair to count for today's lows. 23.26. That's the level, and that matches that previous low right there. So you might want to set a price alert. Let me see if there it is. I have an alert just in case I'm not paying attention. This is what you want to do. These are futures. So this thing can break down at 3 in the morning. You're going to get an alert if you want to be woken up, or when you sit down at your desk the next morning, you'll know that silver broke down. And then of course you'd want to check the chart for gold. If silver breaks down, do you short silver on a break of this if gold at the very same moment has pulled back to a comparable support level? No, you wait for gold to break down, because silver's only going to go so far without its big brother. So if that happens and gold rallies off the trend line, you're going to have a whipsaw. So just like I like to see confirmation with the SPY breaking support, like I started the beginning of this video with, in order to verify a breakdown in QQQ. Same thing with gold and silver. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.